got Daniel Strachman, and we've got a great venture capital panel that's planned out. You know, Miami's becoming more and more of a hotbed for venture capital, and it's really interesting. Alec Andronikov, who's going to be on the panel, has kind of been at ground zero at a lot of this as he moved down with a wealthy family at one point in time recently, maybe a couple of years ago, and was working at their family office. And now he works at a bunch of other family offices on their venture capital investing. And I'm hoping that we can get some insight into what's happening in Florida, South Florida, Latin America. And likewise, I'm hoping that we're going to get some insights into this crowdfunding phenomena that Sherwood Nice described earlier today. I think we've got Nolton Vascovacio on, and Milt has actually a big background in crowdfunding, so maybe he can address some of that aspect as well. So Dan, why don't you take it away and introduce us to yourself and to your group. Dan, you there?
Yep, fantastic. Can you hear me okay?
Yep.
Great. Well, first of all, Marty, thanks for putting this together. It's exciting to be able to do this program again. I know last year was great, and hats off to you and the team for getting this together in a virtual environment. My name is Dan Strachman. I'm with ANC Advisors. We are based in Coral Springs, Florida. We set up shop down here after almost 15 years in the New York, New Jersey area about 6 years ago. We are a strategic consulting firm to the investment management industry, working with hedge funds, private equity funds, and now mutual funds to help them get set up and run their business. I'm excited for today's panel. We've got some great speakers. Why don't we start just in no particular order other than it's how it appears on the agenda. To start with Alec, could you say a little bit about yourself?
Thanks, Dan. I appreciate it. Thank you, Marty, for another amazing event today. Thanks for having us. Alec Andronikov, as Marty mentioned, based here in Miami, sunny Florida, where it's 50 degrees and everybody is complaining and freezing. But it's we've gotten a little soft here, but it's good to be back. I run a multifamily office here in Miami. We invest primarily in technology companies in a number of sectors, including agri-tech, education, fintech, healthcare, supply chain logistics, SaaS, and space. We primarily invest around late seed to late Series B, so kind of like in that $3 million to $20 million range. Our modus operandi is, so we like to find off-market opportunities that we normally find that are led by top quality VCs in tech hubs such as Los Angeles, New York, Bay Area, Austin, and we co-invest with them and give other co-investors, including our family offices, opportunities to co-invest with us into those off-market deals. The deals are always led by a venture capital firm that's very well known, and it's a VC that normally wants us and other family offices that co-invest with us here at LIGO Partners to come in and as a kind of a non-competitive asset class. So it's been a lot of fun being here in Florida. As Marty mentioned, moved here from both Bay Area, LA, and New York, actually triangulating those three cities. So being here now, and very happy to be here on the panel today.
Fantastic. Thanks, Alec. Max, you want to start?
Yeah, Maximilian Winter. I'm from IvyFON. We've been around for just over 3 years, with 35 investments in mostly focused on healthcare, life sciences, and deep tech. And we invest from Series C to Series B. Transitioning to another fund right now. Also focus on healthcare, life sciences, 80%, and the other 20% is on deep tech.
Great, thank you. Hansel?
Hansel Shook, Florida native, so been here a while. Was a longtime investment banker, began venture investing at ADT, and when I led their corporate development group. And then since then, for the past 3 years, have been primarily working with and for family offices, helping them to structure their venture capital portfolios and growth stage investments.
Great, thank you. Milton?
And thank you. It's a pleasure to meet everybody. My name is Nolton Vascovacio. I'm with the firm Gunster here in Miami on Brickell. I've been down in Miami for 20 years, originally from New York, former investment banker as well, Hansel, and now an attorney, working with angel investors, family offices, venture and private equity funds here in Florida and around the country. And most of the investments that we've been seeing lately have been in GovTech and health IT.
Great, great. And Reese?
Yes, hi. So I'm a fifth generation South Floridian. And so to those of you that have discovered Florida, much like the Beatles felt they had discovered America, my question to you all is, what took you so long? We need your experience, your capital, and your energy. It's very exciting to see the huge number of people coming from both the West Coast and the East Coast. And it's a really exciting time to be in Florida. So welcome to everybody. I wear two hats. I'm a co-founder of two structured angel groups here in Florida and a member of a third. And so I've been doing VC and angel investing now for almost 22 years. And it is just exceptionally exciting to see the quality of deal flow and how the ecosystem with regard to the caliber of entrepreneurs and also the various sources of capital funding that have developed really over just the past couple of years is really raising the bar and the barometer of excellence here in the area. And then, so that's the first hat I wear. The second hat is I have a day job with Florida Atlantic University. I run their technology incubator and accelerator. I'm very proud to say many of you heard of a company called Shipmonk, just raised $290 million from Summit Capital Partners. Shipmonk was graduate number 1 of the program that I manage for FAU. And that's just the tip of the iceberg. At one point, I hope, Daniel, I didn't get a chance to send you a question, but love to talk to what I think incubators, accelerators can mean for family office and investors at some point. Thank you.
Great. Well, that's great. I mean, we have a lot of questions from not only from people outside the program, but internally. We've got a bunch of questions. So, I mean, I think we should start right there. You know, we've got all these Floridians on the panel, and as Marty said, we want to talk about what's happening in Florida. So maybe, you know, we could start there. Alec, what are you guys seeing? I mean, you guys are on the front lines, putting money to work all over the place. I'd love to hear your thoughts on it. And then let's just go around and get what other folks are seeing. Maybe they're seeing different things.
Absolutely. So on our end, we are co-investing with a number of very traditional family offices that tend to be down here in South Florida. For those of you who don't know, South Florida is probably one of the largest concentration of family office wealth in the world. Just kind of, you know, if you think from, you know, West Palm down to Boca, down to Fort Lauderdale, through Miami into Coral Gables. It's a pretty nice corridor. What we're seeing more and more is a lot of more traditional family offices tend to start getting into the tech investing game. And I think it's a function of a couple of things. Number one, you know, they're actually seeing returns now in tech, right? Based on tech sector has been performing extremely well, both in private and public markets. Through the craziness that we've seen, which was the year of 2020, it's been a sector that has not been beaten up a lot, unlike some others. Number two, we're now structuring a lot more interesting instruments for family offices that tend to be more conservative. For example, we're now allowing them to come in as a debt instrument, for example, or any non-dilutive instruments into technology companies that before weren't really very palatable to tech entrepreneurs, and now make a lot of sense. So, so traditional family offices now look at this and say, well, wait a second, I can actually get liquid cash flow. I can actually get realized IRR. I can get protected downside risk, and I can get some upside in equity, right, which would come with warrants and a lot of these debt instruments. And so more and more folks we're seeing are dipping their toe in the water, so to speak, and really, really getting into a lot of the spaces, especially spaces that they recognize and they like, and have made money traditionally in this space, such as healthcare, such as commercial and residential real estate, such as education, transportation and shipping, and of course a lot of the Latin American money that's here. And so if they see disruptors in their spaces and where they can say, hey, not only can I invest in tech, but also help strategically, I think that makes it kind of a very well-balanced approach that we're seeing much more so.
Great, great. And Milton, tell us a little bit about what you're seeing. I mean, you're on the front lines papering the deals. What are you seeing down here?
You know, I'm going to echo what Alec just mentioned. Some of my family offices clients are besides their equity investments, are providing a lot of bridge financing and short-term financing. Right now, we're working on mezzanine finance with an equity kicker secured by real estate that is going to be sold, land. So there's different components of the equity and the capital stack that they're looking at, and debt is definitely one component. And right after, the whole COVID, bridge financing was essential, and we filled that gap.
Great. And as a fund manager, Maximilian, what are you guys saying? What's the appetite for both you guys to put money to work, and also the appetite for new investors?
Yeah, we saw a ton of opportunity, especially kind of when COVID hit, with convertible notes and discounts, lower valuations, and especially in both tech and in healthcare. I think people got a lot more kind of confident towards the late summer, and maybe there was a little bit less of that, but I still think it's a trend that there is a lot of kind of extended rounds that are with convertible debt, and yeah, a lot of people are waiting until 2021 to raise their big rounds.
Hansel, how about yourself?
I'll give a little nugget on sort of the Florida perspective, because I've had the opportunity to sort of see it since I was a child. I think one of the great things we have here, which has been a big change, at least in my view, is that talent is staying. I'll put myself in that bucket. Not that I'm that talented, but I stayed. And what I mean by that is, a lot of people used to think that if you grow up here, that you had to start your business in a big center, New York, Chicago, San Francisco. That is unequivocally not the case anymore. And so, in addition to just the natural migration that we're seeing now, which was accelerated by COVID, we're keeping a lot of our existing talent that was born and raised here. And so I think that's what you're starting to see come to fruition in Florida in general, which is probably the reason by which you have not seen venture capital be a major asset class in the state until now. That people did not feel that they had the same sort of opportunities here as a result of talent, and therefore the companies that talent was founding. So I'm very long-term bullish. I think it's a great place to live. Of course, we all know that, but I just see all of the fundamental factors underlying it sort of being very supportive long-term.
Hansel, I just want to jump in here for 1 second, because when I was growing up, the people that were in the Florida school, in the Miami school system were Sheryl Sandberg, Mark Hurd, and Jeff Bezos. So those guys stick around. It's a different type of business.
Yeah.
Well, you also, don't forget that Governor Bush put a lot of money into the school system because he realized this. So he was one of the forefront people thinking about the future of Florida. Unfortunately, it looks like only one of us in this whole group, well, now that Marty's off camera, one of us in this whole group is actually a native, but the rest of us all came here for the reasons you just said, Hansel, because of the weather and the opportunity. But Reese, let's get to you for a minute. Because I think you look at this from two different angles, right? You see it on the front line from an education standpoint, which is super important, but you're also seeing it as it being involved, or I guess you're the co-founder, so your hands are very wet and you're and dirty with New World. So tell us like what you're seeing, especially from the student perspective. I think that's fascinating to hear about.
Yeah, definitely. There's been a kind of recently a revolution in instructional and pedagogical kind of infrastructure available to students, and it's really exciting to see. It's taken a while, longer than most investors would have cared to have seen, but we're seeing a lot of projects. For instance, the engineering students at Florida Atlantic University, every year they do a capstone, when they're seniors rather, they do a capstone program where the first semester as seniors, they do a design project. And it used to be, it was something that the professor thought was cool or neat, or that was needed. And then the second semester, they would then actually build a prototype. Well, it's just a remarkable. It's been flipped around. Now they're involved with the DoD program, where the DoD tells the engineering professors what the warfighters and what the defense industry needs in terms of technology and platforms and capabilities. And that's what the students then work on. And they no longer work on with their own little kind of like silo, but they actually form interdisciplinary teams where they've got mechanical, electrical, computer, structural, et cetera, all together working together on teams, a lot of cross-pollination, et cetera. And they're producing really interesting technology, frankly. I tried a couple times to turn them into companies. The reason I couldn't do it was these young, bright kids ultimately have to pay off their debt, and they go and get jobs in major engineering firms and corporations. But I'm trying to fix that too, trying to get some of these projects, into with management that can actually move it forward. So I think that's really positive. If there's one program that's come out of the National Science Foundation, actually was born in Silicon Valley. It's called iCore, or Innovation Core. That's I-CORPS. It has really kind of flipped the entire concept of rather than build build, sell, pray. Basically, first do 100 customer interviews before you even build your project. It's really flipped the whole process of starting a company on its head, and it's very impossible. It's almost impossible to get professors to get it, but students will get it. And slowly but surely, some of the professors understand, okay, I've got a technology, but I don't know what type of product it should be, and I don't know which customer is ultimately going to buy the product. So that pedagogy, iCore, is really a game changer. Then on the fun side, I'll just say quickly something, because I think the panelists have really hit kind of the low-hanging fruit. I'll mention how COVID has kind of changed angel investing and relevance to family offices. I think some of the aberrations that COVID is kind of spelled out in the public markets are spelled out even in more greater detail in the private markets, in particularly early stage tech financing. I have a portfolio of probably about 35 investments over the 3 groups that I'm involved in. And like almost not overnight, but within short order, we had a whole new set of winners and losers. All of a sudden, our telemedicine companies that were struggling to get a foothold were overnight rock stars. And then we had events management platforms, particularly in like the job fair and career services space. Boom, they're expanding like tenfold in terms of revenue, like within 8 months. And then the flip side is some of the other folks that companies that were not as enabled online. And required kind of more of at least a retail component, were really in trouble, except those that got CARE financing. Those that got CARES Act financing, ironically, were turning down we would have notes, like follow-on financings in process. And they'd say, oh, never mind, got our CARES Act financing. And like, we're actually happy with that because it's non-dilutive financing, allows them to, at least kind of tread water. And then if we're going to put in additional capital, we'd rather do that for expansion or other, building infrastructure in the company itself. Last comment I'll say, and that is, I would encourage your family office professionals and members to engage not only with structured angel groups, but with the incubators and accelerator facilities in our region, because I think they do a significant job of bringing a unique deal flow source that you might not otherwise see. And they have grown in sophistication, where a lot of the heavy lifting on background checks, on relationship checking, and on kind of proving out some of even the IP review has already been done. And what we often need is just groups that have some heft financial to help top off a deal, or perhaps even to anchor it if that's of interest, provide a little additional governance. Rather than just taking 1 board seat, we'd like to have 2 board seats with an allied family office member to take that and help govern with us. And then I think incubators and accelerators do an exceptionally good job of listening to what family office members are interested in, what they're looking for, what they want to invest in, and then bird dogging, not only within their facility, but within the events. Think about it. Folks like me in our day jobs, we get paid all day long to think about resources and tools and ecosystems and relationships that can help these entrepreneurs. And so if we know on the investor side what you're looking for, we can absolutely bird dog, and you don't pay us a cent.
I think it's very helpful. So let's I want to get back to the CARES Act, because it looks like, in light of some of the news that's coming out of DC today, that there'll be another round of funding for folks to help them out through these difficult times. But Milton, one of the things I want to ask you about, and Marty had mentioned this at the outset. Tell us a little bit about what's happening with crowdfunding now. There's been some changes with the SEC and that fund, and that's under that banner. So tell us a little bit about what you're seeing and how you're advising your family office clients on those issues.
So my family office clients are not invested through crowdfunding. They're doing mainly direct investing and some co-investing with funds. So what I've been seeing in terms of crowdfunding is, an increment of utility, especially like I would say in areas that you wouldn't ordinarily expect. Most people, when they think about crowdfunding, they think about equity crowdfunding. Well, there's actually a real estate crowdfunding component to that. And a lot of that actually originated here in Florida. I used to represent Early Shares, which was started out as an equity crowdfunding platform and then switched over to real estate and raised capital for companies that were looking to acquire multifamily or whatever other type of real estate they were raising funds for. But crowdfunding rules have been recently modified. The SEC's harmonizing several of the exempt offering rules, and they recently increased the amount of crowdfunding that can be raised in a given 12-month period to $5 million, much higher than it used to be. So that's allowing several companies to access it. In my clients, I've not seen a lot of companies utilizing it because Rule 506C is actually one that they use more, and 506B, and it provides for unlimited access to capital, and really none of that additional regulatory burden that you would have. So crowdfunding's definitely a utility that a lot of people are considering as another component to the capital stack. But in my personal case, I'm not seeing a lot of the utility here in Florida.
Anyone else have any thoughts on that, or should we move on to another topic? Wow, we got crickets. Okay, so
I'll just mention there's one gentleman down
always
here.
the professor comes back with something.
Sorry.
You ever notice they can't stop talking? Go ahead, Reese. I'm kidding. Come on.
No, you're right. You nailed it. I agree with Milton. As much promise as crowdfunding had in this regional market, not seeing a lot of it. Interestingly, Barbara Corcoran, many of you know her as one of the sharks. She has a full-time professional that runs a fund for her, and he does it completely through AngelList. She'll basically, anchor a deal at 100,000 to 200,000, and then he'll just basically syndicate it through AngelList. So that's just interesting. But Milton absolutely nailed it.
I actually want to jump in on this question just real quickly, because I actually know the people that were with Milt's earlier crowdfunding firm. They presented with us maybe 5 years ago, a couple blocks away over at the Hyatt. But I think it's a real interesting thing because so one of the things that AngelList provides, and we have dozens of VCs who come to us who are ex-AngelList syndicators. One of it provides the ability to really review the statistics and performance of beginning portfolio managers. So my thoughts on crowdfunding is that if it provides that kind of data as well, it'll be a good competitor to AngelList in terms of nascent fund managers. So
one thing I would add to that is you could still use the crowd platform to raise 506C. So in fact, that's how most of my clients have used the crowdfunding concept.
So I guess, Alec, one of the things that, you guys are on the front lines putting money to work in the market. I know the other, Maximilian and Hansel are also doing it, but I guess the question I have for you is, how are you guys operating in this environment, this COVID environment? Clearly, most of our wings have been clipped. We can't get out on the road and really kick tires and things like we used to. How is that affecting you guys and what you're doing?
It really hasn't changed much. Look, allocations are still happening. People are still investing. I feel the industries have changed dramatically, right? So, for example, we saw a lot of investments in cannabis and hemp in 2019 that completely died off in 2020. We're seeing a lot more emphasis on things like education, artificial intelligence, and more traditional spaces. Infrastructure, agriculture, so a lot more kind of tactile things. But I agree. I mean, it's very interesting. The way our business model works is, again, we never lead a round. We always top up rounds. And so for us, it's actually been kind of a blessing in disguise, right? Just the ability to be able to very quickly hop on a call with somebody versus having to fly or even walk down the street has been just, extremely efficient to get things done. And the VCs are the ones that are leading the rounds for us. And again, we're bringing in our family office capital as well as our co-investor family office capital to the table. So when it comes to things like due diligence, that's done by the lead VC. And how they do it, varies a lot. But I feel like people are getting a lot more comfortable with writing checks over Zoom, which I think is pretty crazy. But it works. It works. There's a lot of things that you can do now today. And as things kind of open up, I feel like people are starting to fly and travel. But 2020, we ended up deploying just over $65 million in capital across, again, late seed through early Series B. In both equity and debt instruments, and it's all been virtual.
If you were operating in venture pre-COVID in South Florida, your life didn't change that much because most of your calls were remote anyway.
That's a good point.
That is absolutely true.
So maybe you guys can address the issue with seed versus like Series A and Series B funding, because we do a lot of events in Austin, Texas, for example. And Austin it's always a big problem once you get to that Series B to find a fund that will fund you. So, and Alec, you're kind of a child of a lot of different places. So maybe you guys can address that and talk about, what do you do? I mean, you're talking about making phone calls for next level funding, but what do you do when you get to that, Series A, Series B segment?
Yeah, Marty, it's very interesting. So Miami reminds me of Austin about 10 years ago. So obviously university. Great talent, as one of the panelists was referring to earlier. Some phenomenal big companies that will lose that talent to go off and start companies. The difference, I think, between Austin and here is that Miami thus far has not necessarily been about where you invest. It's who the investors are, right? And so I think the dynamic is a little bit different from Austin. So Austin is hard to raise because they're actually entrepreneurs there versus investors. We flip the dynamic upside down, sort of. We have a lot of investors, and they're not investing necessarily in South Florida. They're here because of tax reasons. They're here because of the weather, et cetera, right? So some myriad of other reasons why they're here in Florida. And I feel like they're not necessarily flying anywhere because guess what? They already have the established network in the New Yorks and Los Angeleses and Austins of the world. So we have investors. Austin has entrepreneurs, and that I think is the big difference. We don't necessarily travel to go raise money because we already have those networks established, and that's kind of a different dynamic. So I feel like Miami could actually explode a lot quicker because investors are already here versus entrepreneurs being there first and then investors coming in afterwards.
Yeah, I think we need to think about the totality of Florida, because there's a couple of 100,000 students in Orlando area, right? And University of Florida, University of Central Florida probably are two of the largest alumni associations in the United States, if not the world, right? I mean, I think there's like 500,000 University of Florida alumni out there, right? So food for thought.
So I think that's a good point, Marty, and I think, Alec, you're right. This is where the money is, right? So that helps a little bit. But Maximilian, tell us what you're seeing for trends for 2021. Obviously, you guys are looking to put money to work. Well, tell us what you're seeing.
Yeah, we're not really seeing the hot sectors from 2020 slowing down unless there's kind of a crazy run up in tech stock prices, or somehow this SPAC mania is going to backfire. And I think healthcare, life sciences, and kind of these breakthrough new technologies, frontier technologies like space tech, are going to continue to be hot, and maybe even heat up a little more. I think that, like I said, the only way that this could get derailed is if there's some big macro event and everybody's cautious, or if the valuations run away. But in early to mid stage, seed to Series B, and I don't necessarily see that, especially now that there's the ecosystem is becoming more decentralized and you can almost start a company anywhere. I think that will benefit from expenses people being able to keep expenses down, and maybe that won't inflate the valuations as much as it has before.
Hey, Max, can you talk a little bit more about space tech? And I'll tell you why. I was approached by a Boston VC fund saying, they have the inside track on stuff coming out of NASA. I have no idea where NASA is even headquartered, but I know there's a big space center in Central Florida. So maybe you can talk about that some?
Yeah, there's certainly NASA and DoD and all of these agencies have their own kind of innovation ecosystems. And I think that's where some deal flow originates, and others. For example, I'm an investor in another fund. It's called Prime Movers Lab, and they're kind of deep tech, frontier tech, and co-invested with them in a space tech company called Momentous that is they're doing in-space transportation. That's kind of a multiple cheaper for deployment of communications like satellite. And this is a company that benefited from the SPAC mania. There's a lot of, I think, deep tech companies, and that includes a lot of the space companies that need a ton of capital to really get going. Oftentimes they have the concept validated, and they just need a ton of money to fuel up. And then and I think a SPAC is a good vehicle for that, especially since it seems like the public investors have been a little bit just hungry for new innovation, and maybe the valuations are too high for a Tesla or an Amazon for them, the established big tech stocks.
Daniel, can I just tag on super quick?
Sure, of course.
Milton and I have the privilege. I have the privilege of serving with Milton on the Florida Venture Forum's board. That's the trade organization for the venture capital industry and the angel group and family office industry in Florida. And that Florida Venture Forum has an aerospace capital conference every single year in Orlando, and it increasingly is getting really interesting. A lot of companies, not only from the U.S. outside of Florida, but also from London and Spain and stuff like that, but very specifically focused on space tech. And very impressive this past iteration, which in terms of the quality of the technology and the management team. So you might want to check that out.
Yeah, I would add to that, Dan, if I may, that Reese is correct. I mean, Florida is actually not only, the epicenter along with California of space exploration. There's an agency in Florida called Space Florida that basically took over the responsibility of private exploration rights. And that's where, Elon Musk and Bezos have their businesses where they're, actually launching rockets nowadays through the private exploration rights that they receive from the Space Florida people. Plus, Space Florida also has access to money that's been granted to them by the state to help incubate companies. So that's another vehicle that many people who are in the space tech world ought to take note.
No, that's interesting. That's interesting. I was up at Cape Canaveral when they brought back one of the SpaceX rockets, and I had the pleasure of standing under it. It's unbelievable how cool that is. It's pretty cool. And I highly recommend for any of you when it gets a little warmer, because it's pretty cold down here now, but go up there and see Cape Canaveral and the museums. It's fantastic place to spend a couple of days. Hansel, one of the things that we were talking about when we did our prep call was, how do you create a good portfolio of venture in this environment? Do you go early stage? Do you focus only on later stage? Talk to us a little bit about how you're seeing that done now in this environment.
Yeah. I mean, I think as people are starting to wrestle with whether they're to make a move into this asset class, there's a few things that they need to do a sort of a self-audit on that would really help. Number one is, what is their historical comfort level with venture, right? Have they done it at all before? How far away from this style of investing have they been? In other words, if they've been in nothing but real estate and fixed income for their entire investing careers, moving over to a highly volatile, operationally focused, product focused investment style is going to be a huge leap. And therefore, depending on what their natural inclinations or predilections have been, making some sort of decision on what level of external help they involve, right? So are they looking to build a team internally such that they're doing all of their direct investing, all of their due diligence, et cetera, in-house? Or are they going to simply look for funds to execute their strategy? Those are all decisions I think they have to make. If they do go the direct investing route, I think one of the biggest things they need to understand is that it's a volume game, that they're going to be there. There's a huge ground effort that has to be put in place to make it effective and successful. On the flip side, I mean, you know, we've got Alex here with LIGO, who helps family office generate deal flow. I think that's a fantastic model for people who want to see specific deals and not have a bulwark in place in the form of a true GPLP, but have a little bit more of sort of an outside team handling a lot of the deal sourcing. And then there's spectrums in between. So I think you really have to do a good self audit to understand both what you're comfortable with and what the structure of the effort's going to look like.
That's good. Alec, what are your thoughts on that? I mean, you guys are again on the front lines as well.
Yeah, so funds, it's interesting. To 2020, you know, we talked about a lot of paradigm shifts when it comes to investing. Definitely, we've seen a lot more family offices shifting into direct investments. A couple of reasons. Number one, family offices no longer want to pay the 20% carry to somebody, and let's say, you know, with another 2% average management fee over, let's say, 5 years, that's about 30 cents on the dollar that you're giving to somebody else. And the question there is, you know, is there really value there of doing that? So that was always number one. Number two, liquidity, right? So if I'm investing direct and the company exits, I get distributions. In a fund, that's not necessarily the case. So I think, you know, and the third is, of course, timing, right? Timing of the exits. And so people, our family offices kind of look at that and say, okay, what's the real value of investing with a fund? Now, there is a big exception to the rule, and the exception to the rule is if a fund has realized IRR, which I know in the rest of the finance world is a very common term. In venture capital, that tends to be a very loose term. So a realized IRR exits, right, with some kind of a very competitive advantage, or I should say unfair advantage of a fund, with operators in the fund, essentially founding partners that have successful track records, that are very focused on specific things and specific categories. Those funds tend to do very, very well with our family offices. For example, most recently, we're working with a fund called Lever, which is Lever, which is a very, very interesting protein alternative fund. The team has phenomenal IRRs, having backed companies such as Beyond Meat way before at seed. So obviously, you have seen how the stock has done both privately and publicly. And they're very, very focused on a specific domains, so they're true domain experts. They're doing phenomenally well in that particular category. Another fund called Blitzscaling in the Bay Area, which is anchored by Reid Hoffman. Obviously, Reid, very well-known guy from the PayPal mafia, and having some exits with the folks next to him, obviously add a lot of credibility to the fund. And Blitzscaling, as a book describes, is a particular way of investing that's very, very niche, but also very, very interesting to a lot of specific investors. So to kind of summarize, direct is the way to go for the majority of our family offices, but there's definitely a lot of opportunity if you're a fund manager that has realized IRRs, and understanding kind of, you know, a specific domain and having unfair advantage. those funds tend to raise really well as well.
I think that's a good point. So Maximilian, one of the things that, you guys have experienced both as an LP and a GP, and how have you used that experience to sort of leverage and build out the fund that you guys are running today?
Yeah, it just gave me a great inside scoop on institutional fund processes all around. I think, including due diligence, LP, GP communication, annual meetings, SPV co-investments, the role of a lead investor, and I think a few other things. So I think it's mostly about establishing these institutional investment processes and also carving out a niche for yourself that you have that unfair advantage, and I think additionally you learn about LP needs as well.
Great. I think that's interesting to hear about, because to see it on both sides. So one thing I know that I think, Alec, you said cannabis dead. What else did you say was dead? Something else you said was dead. Not blockchain though. What are you guys thinking about blockchain and crypto? I mean, obviously we've got we got BTC almost at 20,000. I know that a lot of interesting new products coming out, leveraging not only cryptocurrencies but blockchain technology. Any thoughts on that? I mean, anyone want to comment on where they see that industry going or what's happening there? Crickets. Come on, Reese, you gotta have something.
I don't know a ton about this, but I'll make it quick and go first. I think it is not a safe haven. There's a study by the Fed in Kansas City or something that was done that kind of proved it's not a safe haven. So I think it's more an asset class that does well in good times. And I just read about one that Steve Wozniak started on energy efficiency. It's quite interesting. But otherwise, not too deep into crypto.
I have a very kind of contrarian view on this. If 20 guys control the whole market and they wake up in the morning and say, "What do we feel like doing today? Oh, let's short some of this, right? Or what do we feel like doing? Let's make a little bit of money." To me, it seems like legal insider trading. Because it's essentially it's a major oligopoly with literally 20 people controlling over 90% of the paper out there when it comes to Bitcoin or whatever it is, right? So I just I don't think it's a fair market kind of true laissez-faire system with an invisible hand.
Yeah, my thoughts on it. I mean, I split those two very distinctly: crypto versus blockchain. Crypto is not that interesting to me from an investing perspective, just because there's too many commodity / political considerations with the way that the DAC works and all of the underlyings there, and you really got to dig in. On the blockchain side, yes, there is potential, but I believe what will happen in that market is, if it does begin to achieve adoption at scale, that it's just going to be another underlying background technology that nobody's really going to know who the name of the company providing it is. It's just going to be part of the stack. And so you'll need some chops to understand and validate that the technology says what it does, what it says it does, but it'll just be another piece of the pie.
Can I just jump in here, guys? Since we had Bitcoin going around the country with us, Pantera, when Bitcoin was at $60. So I don't think there'll ever be a leg up like there was in Bitcoin before. And actually, if it ever goes, like if all the crypto in the world, which is probably around 600 billion right now, goes to, let's say, 6 trillion, then it's going to be a major displacement in the commodities market. I mean, you can see if crypto goes to 6 trillion, then I don't know what's going to happen to gold, but I think it's going to decline dramatically because of all those people are moving away. Getting to Alec's point about an oligopoly, there's no doubt about it. What's interesting is that crypto was going up, or Bitcoin was going up to around 19,000, 19,500. And then a bunch of the oligarchs moved their cold storage crypto to trading platforms. And when that was seen, crypto or Bitcoin dropped by $2,000 next day. So just, confirming what Alex said, And then my final statement is something that Bob Bozeman told me once, probably 10 years ago. And he's one of the co-founders of SV Angel with Ron Conway. And he said, you know, at some point things become infrastructure. Like nobody talks about nanotech anymore. And I think that's the same thing that's going to happen with blockchain, just, you know, backing up what Hansel just said. So I think we're on target there. I think in venture, there's like some really super exciting spaces, including space, and is very exciting, and fintech, which seems to be gobbling up a lot of finance. So, and I think we're just like in the second inning or third inning of fintech.
So that's a good little segue there, Marty. I know we got about 10 minutes or 15 minutes left, but from you guys from an investor standpoint, and Milton from a deal standpoint, what are you guys seeing in fintech? I mean, you know, Robinhood obviously is huge this year. There's some big payment companies that have been doing some interesting things. You see other sorts of technology platforms being developed particularly for like fund administration and you know, document delivery systems, particularly for in the financial services space. So what are you guys looking at in terms of fintech opportunities? I don't know who wants to start. Reese, you want to start?
Of course I want to start. I love starting. Thank you. Yeah, so from the incubation acceleration space, what we're seeing is some very creative entrepreneurs disintermediating the entire payments processing space with regard to credit cards and ETFs and things like that. You know, that's an incredibly kind of disjointed ecosystem to begin with, and there are some key players in there as well. But that is being remarkably, as I said, disintermediated by some very nimble, very creative entrepreneurs who they really have to pivot significantly and find. It's hard to go into one thesis, but they essentially find one main provider, and maybe in the banking space or in the actual charge card space, and figure out back into what they need, and then provide it in some cases in a new way, or in other cases service an underbanked or a non-banked segments, such as gig economy workers. Many of them have all these things. They need not only their paycheck, but they need kind of documentation, paper trail, tax, all those things that normally would come with a paycheck. And so we're seeing entrepreneurs doing some neat things in that area. And we're also seeing a lot of kind of AI going into that space, using bots to help alert people to purchase better and to purchase even in groups, well short of Groupon, but kind of like micro group purchasing. So I think there's a lot of innovation there. It's tough to really kind of monitor, tough to get your head around completely unless you're a specialist, is my belief. But I do think that we have years of innovation ahead of us in that space. And Danny, I want to mention one other thing. We talked about space tech as an exciting thing. One thing you heard it here, folks, marine tech. Everyone thinks of space and ground, but Florida has a competitive advantage in marine tech. I see it firsthand. Exceptionally exciting. Mention one company we have, underwater Wi-Fi. Think about that. You can communicate with connected devices underwater using special algorithms and technology. Incredible applications in environmental defense, physical security, things like that. Really neat. Fleet control. Very exciting.
You know, it's interesting you bring that up, Reese. We were looking at an opportunity a couple of weeks back, similar, but in the fishing markets, and it's a Florida-based company, figuring out how to harvest fish better, right? And you think about that. I mean, that's a food source, right? Food production from, and it's an unlimited source, quite frankly, because even though some species are dying off, others are growing. So you're right, and people don't think about that with Florida. I think it's a good point.
If anyone's interested, I've got all kinds of interesting deals in that area.
Also,
make sure if you do that, you give Marty a vig on those because he's bringing the deals to you.
Oh, Marty.
I mean, really, you got all these investors in front of you. Milton, go ahead. Tell us what your thoughts are.
No, I was going to mention that on the point of fintech, the mortgage underwriting business has been utilizing a lot of AI to approve credit, and you see that companies like SoFi and others that have come about. I think SoFi has actually applied to go public. So, I mean, I think fintech-wise, the mortgage real estate industry is definitely adopting the AI, the machine learning technology.
Yeah, I think that's a good point. So let's talk about. Give us each your. We got 10 minutes left, so I'd like to go around and why don't we start with you, Maximilian, tell us what your number one sector to look at in 2021 is going to be.
I think it's computational biology, platforms that generally have multiple shots on goal. It could be biological platforms or a medical device, other things that have multiple indications. We see some companies that have over 10 indications, all in the pipeline, and I think that's much better than the single cell approach that has a ride or die molecule, and then the whole company tanks when it doesn't work out.
Alec?
For me, so let's go back to the fintech real quick. So we think there will be a lot of M&A opportunities. So therefore, good time to invest now into the unbanked sector, right? So for example, one of the companies that we're super excited is a company called Recarga. They go after the unbanked population of Brazil. Now, Brazil is just one of many countries in Latin America where most of the population is unbanked, right? So unbanked meaning no credit cards, no bank accounts. Huge opportunity. Same in Africa, same in Southeast Asia. So we're very excited about that as one sector. And then the second sector we absolutely love is education, specifically distance learning. When it comes to children under a certain age, especially now when children are at home, right? And that might continue into 2021, most likely in a lot of countries. So distance learning and education as a whole, again, a lot of companies sitting on a lot of cash there to be able to make small M&A acquisitions, right? And as well as some of the larger, more public companies that are willing to place some of the larger bets out there in 2021.
Hansel? I think you're muted.
Thank you.
Sure.
I think the one I'm really interested in right now is robotics and the automation of physical spaces. So there's obviously we've known Amazon was a big early adopter of robotics and logistics. We're seeing it now with automated vehicles having robotics included on them to deliver things, etc. So I think the application of robotics beyond just manufacturing facilities is really just starting.
Can you talk a little bit, do you know anything about automated warehouses? Because it seems like that's the next step up. So we actually had a real estate fund that was doing fantastic business selling industrial spaces to Amazon during the breakout of COVID. And a lot of that was, and they were outfitting all of their industrial properties with robotics capable spaces.
Yeah, the robotics industry organization, robotics.org, estimates that warehouse and logistics is actually going to be a larger consumer of robotics technologies than manufacturing in 5 years, just to give you a sense of that segment. So and that is just one of many other segments. I mean, another big one is going to be agriculture, with further automating our food supply. It's going to be a major growth sector over the next 10-15 years.
Milton, what are you seeing from your clients?
Lots of healthcare technology, utilization of robotics in not only surgeries, but also the use of predictive analytics and AI and machine learning in the application of healthcare. Maintaining using predictive analytics to really keep costs down and improve service.
Great.
Hey, Mill, just real quickly, and I know we're going to have a healthcare panel following that you're going to be on, but it seems like healthcare kind of been pushed forward, and I think somebody spoke about it earlier, by a few years, especially when it comes to healthcare IT, things along those lines. Maybe you can discuss that a little bit here, because
the use of telehealth is an example of something that really got moved forward. I mean, it was paid for by the Center for Medicare and Medicaid Services previously for rural services, you know, for approved rural services, and now it's approved for, you know, the entire country in about 144 different cover services, and it's expected that it will continue. So.
And does anybody have any thoughts on longevity and longevity investing? I mean, obviously, that's been a big space for the PayPal mafia. We're here in Florida, which has more older people than any other state. So does anybody see anything that's interesting? I mean, when you go out to San Diego, there's tons of people doing research in this space. It's like a San Diego thing. Any thoughts here?
I'm actually in the process. I'm in the process of co-founding a company with a researcher out of Harvard Med School and MGH, and also a public CMO guy. And one thing struck me is that the tools, the bio tools that are used by researchers and by biotech companies, in itself has experienced a remarkable revolution. It's significantly driving down the time and cost continuum, where we can get much better results with much greater predictive value in just an absolute fraction of the time we used to, and at a fraction of the cost. And I think that is accelerating research, specifically in the aging space, but really across the whole continuum of life science projects.
Yeah. So we gotta wrap this up in a couple minutes, but we have a question from the audience, and I'd like to just see if we could get that answered before we pass the torch to Milt. So quick comment I'm just going to read it out. So if it's incorrect English, it's not my fault. Quick comment by one or two on how processing potential exits in current COVID recovery environment. Anybody's thoughts on that? Come on, someone's got to say something.
Processing exits,
Yeah.
getting exits.
Can I just make one comment before we get into that? So there's 400 unicorns right now, and I think there's 20 to 30 IPOs a year. So does it seem there's more mergers and acquisitions happening, or maybe you guys, that's another way to phrase the question, especially in today's environment?
Well, I'll touch on that with, I think there's been over 200 SPACs this year, and I don't really see that slowing down in 2021. We'll probably have more than 200 next year as well, from what I'm seeing. I think that'll contribute a lot to new unicorns and plenty of IPOs, especially in the healthcare and life sciences space, but also in things like space tech and a lot of things that require a lot of capital.
I was an M&A banker for a long time, and the big thing about achieving an exit is you need to be thinking about having a long-term view as to when you're going to actually pull the trigger. Right. In other words, it's ideal to have an IPO track as well as a strategic sale or a private equity buyer, whatever you may prefer. The more options you can have on the table and the length of time by which you can achieve that, the better you're going to be. So the shorter your time frame is, the more likely you're going to have to take a bid on a lower price. It's always been that way, and I don't think it's different this year.
Can I just get some more insight into this SPAC comment? Because I mean, 200 SPACs, is that worldwide or just US only? I mean, I know there's been a bunch of SPACs in the cannabis space in Canada, but maybe you can discuss a SPAC, because it seems to me that there's two levels of SPAC, right? There's the initial offering, and then there's the approval that requires 90%, right? So do we know how many actually go to be successful?
I don't have that number. I think it's worldwide, but would have to verify that.
Right. Okay. Keep on going, guys.
Okay. Reese, any thoughts on that?
Yeah, just some companies are just, reflects the personal wealth market, but some companies are extra flush with cash. And also because people are not flying around or spending time in the hotel, there's a lot of productivity now. So there is the cost of doing deals, and the available war chests for many companies in specific sectors are quite large. So you see that. And then in other sectors, it's nuclear winter. Nothing's happening at all. Companies don't have cash and wondering what their future is going to be like. So it's very much a tale of many different cities.
Right. Well, the one thing that we know will always go, and there will not be a winter, is Marty's programs. So with that, I think it's time to end this panel. I want to thank everybody for participating. Really great insights from everybody, and hopefully we can do this together in person before not too long. So stay healthy, stay well.
I hope so. Milt is the expert on Gunster here, so I'm hoping that maybe after everybody's gotten a vaccine or their parents have, we can do something in person here in Miami. So
It'd be fantastic. We'd be happy to host it.
Yep.
Great.
Thanks, everybody.
Thanks, everyone.
Great
Thank you.
panel.
Thanks, Daniel. Great.
Thanks,
Moderator.
Mike.
Please feel free to share your contact info through the chat with all the other people who are here right now. And we'll send out more information later as well. So again, thanks so much.